everyone. Thank you for joining TAD for today's webinar, Home Health Industry Updates. TAD was founded to provide an option for home health agencies to outsource their billing, accounting, and consulting services to industry experts. Our esteemed billing specialists, accountants, and CPAs have dedicated themselves to the home care industry and bring their knowledge to you today. I'm Mary Reyes, Director of Operations at TAD, and I will be your moderator this afternoon. It's my pleasure to introduce Dan Parker. Dan is Vice President and owner of TAD. He has his MBA and has been a CPA for over 35 years. He has practiced in the public accounting throughout his entire career and has serviced the home care industry since 1981. Also, please welcome Tonya Elkins. Tony is our billing coordinator here at TAD and has over 30 years of medical billing experience, including employment within various home care agencies throughout her career. She has the ability to research troublesome processes within the home care agency and offer practical billing solutions. We have a lot to share with you today, so we're going to get started. All of our attendees are in listen-only mode, but please feel free to send your questions to us throughout the webinar via the question box on the right-hand side of your screen. If the questions pertain to our current subject matter, we'll answer them throughout the webinar as we proceed. But due to time constraints, if we have already covered that area, we'll answer those questions at the end of the webinar during our question and answer period. After the webinar has ended, please post. Our contact information will be posted, and there will also be a questionnaire that will pop up when you exit the webinar. Please complete those. It's just 5 questions. We'd like to know what your opinions are on our subject and if there's any other information you'd like to share with us. So let's get started. Here's Tony.
Thank you so much, Mary. And I'd also like to welcome everyone to the TAD 2019. I'm sorry, I have 2 mics. So is this the wrong mic? Testing. Okay, again, I'd like to thank everyone for coming out to be present for our 2019 industry updates. By now, everyone is aware that PDGM is coming. The proposed rule was released, the comment period is ended, and now the final rule has been printed. So what's next? Well, this afternoon, my goal is to make sure that our providers and our listeners have an understanding of what has changed from PPS to PDGM and how the claims will be processed in 2020. So let's go ahead and get started. I'm going to look at what's going out for PPS and what's coming in for PDGM. I'll be discussing areas from the OASIS assessment data collection all the way down to the final claims processing and expected reimbursements. Under the OASIS assessment, under PPS, when we first started this in 2000, we actually started submitting our OASIS assessments to our respective states, and then Medicare consolidated everything, and they came up with a keys area for all providers to submit their claims to, which is the quality improvement and evaluation system. Under PDGM, the OASIS assessments will still go to one centralized location, but it's going to be known as the iKeys area, or the Internet Quality Improvement and Evaluation System. If you have not registered to submit your OASIS assessments through this site, you need to do so, because December 23rd is going to be the cutoff, because they're going to shut down to prepare to switch everything over for the PDGM system. And then your OASIS assessments for the PDGM will start to be accepted beginning January 1 of 2020. Also, in terms of OASIS assessments, under PPS, we used to submit SCIC assessments. Those that's been around for a while, you remember those significant change in care. Medicare discontinued the use of that because they realized that under the SCIC assessments, some of the agencies were taking a loss because of the way the claims were prorated, going between 2 different HIPS codes for the reimbursement. So Medicare felt that they were not trying to cause patients to take a loss because they were reporting this data. So the SCICs went away. However, under PDGM, we can expect to see them again, because under PDGM, the SCICs will allow the system to identify changes that may have an impact on the provider's reimbursement. The OASIS should still be filed and submitted within the required amount of time, making sure you get the data to Medicare within that 30-day time period. If for whatever reason a diagnosis code needs to be changed after you've submitted your OASIS assessment, then you would go in to submit those SCIC assessments. But you want to make sure that you're submitting these SCIC assessments before you submit your final claim. So when your final claim is received by Medicare and Medicare looks for that data, it will be on file. Period timing also has changed. In PPS, period timing was still early and late, and it defined two different time periods. For early, it was the first 60-day episode, the first two 60-day episodes, excuse me, and then the late would be considered anything from the third or greater. But that's going to be different under PDGM. Your early episode timing is going to be defined by periods. The early is only applicable to your start of care periods. I want to stop saying episodes. It's only applicable to your start of care periods when there has been no other home health care periods on file for 60 days or greater. So you can define that as an early. Any other period, second or greater, would be considered a late period. If the agency does report an early period to Medicare, and Medicare has another agency on file with a claim within that 60-day range, Medicare will automatically do an adjustment and regroup that claim and pay it as a late, even though the agency may have erroneously reported as being early. These auto adjustments will be done to update both a late claim filed to an early if Medicare does not find there's another home care agency on file, as well as I stated, to change an early to a late if necessary. Please keep in mind that when you are calculating your period timing, your Medicare Advantage plans, they're not to be counted to determine whether or not you are providing an early or a late period. Medicare is only looking for you to report the early and late when it comes to your Medicare periods. Admission source. Under the PPS, there were several types of options to say where your patient was coming from: the doctor's office, a hospital, a community. But under PDGM, that's changed. Whereas PPS, when you define what your admission source was, that remained your patient's admission source throughout the care. But under PDGM, each 30-day period will have its own admission source, be it institutional or community. It's possible for your 30-day period to have a community admission source from the beginning, but then your subsequent episode to have an institutional. For example, if there is an acute hospital stay that occurs within 14 days before the start of your next period, the home health agency would do a transfer, not discharge OASIS assessment, followed by the resumption of care assessment. Then that subsequent 30-day period will qualify as an institutional admission source. If that inpatient stay would be characterized as a subsequent payment period, it's only applicable if the patient does a discharge transfer in order for it to be considered for payment. If the patient is coming from, if you're currently seeing the patient and the patient experienced a transfer to an acute inpatient stay, and the home care agency does that exact same practice, transfer, not discharge, and resume the care, that subsequent period would not qualify as an inpatient, an institutional, excuse me. It would be considered a community. In order for the provider to benefit from a patient going to the hospital and returning within that 14-day for an acute inpatient stay, they would have to do a discharge. So it's important that you understand what type of transfer you will use when you have a patient that's under your current care and they need to go to an inpatient stay. Again, The type of institutions that will qualify as an institution for inpatient stay within 14 days from the start would be a skilled nursing facility, an inpatient stay at a rehab facility, inpatient psychiatric facility, or a long-term care facility. You would also need to make sure that you utilize your occurrence codes, 61 if it is a hospital stay, and occurrence code 62 for those post-acute inpatient stay. Now, if an agency is not aware of an inpatient stay discharge when they submit their claim to Medicare, this will be another one of the areas that Medicare will do an automatic update if Medicare finds that they have a claim on file reported from an institution. If the agency reports a claim as community and Medicare finds that the community information was not correct, this too will be updated. Now, OASIS data collection, there is a question on there, that M1000, which asks the question whether or not there's been an inpatient stay in the past 14 days. This question on the OASIS does not factor into the calculation of the payment for your PDGM. So there's no need for you to go back and start trying to correct your OASIS assessment if you find that you reported on the OASIS that there was no inpatient stay and later determined that it would be. So that's not necessary. However, there may be a need to submit a corrected claim if the patient has an inpatient stay that was not reported to Medicare, because Medicare can only do their auto adjustments if they determine a claim has been received from a provider that submits to them. But providers such as Veteran Affairs that does not remit claims to Medicare, Medicare does not see those claims. So in that instance, if you become aware that there's a change, you may want to do an adjustment to your claim to report the correct hospital inpatient stay. You only want to report one occurrence code, 61 or 62 on your claim. Even if you find that the patient may have had 2 different inpatient stays, you want to use the one that has the latest discharge date as the occurrence code and date to report. If the home care agency submits a claim not reporting any occurrence codes, Medicare will automatically group that claim as community. And if later on, again, a claim comes in, even though Medicare did the auto grouping, they'll also do an auto correction and change that patient's admission source. And you'll see this on your remit device with a 32G type of bill, noting that Medicare performed this adjustment. Now, these auto adjustments that I'm talking about that Medicare will do, changing the admission source, Medicare will only continue to look for this as long as the claim is within timely filing. So having said that, if the institution provides their claim to Medicare after your timely filing has expired, Medicare is not going back to make adjustments to those payments. Now, briefly, I want to mention therapy reimbursements. We know under PPS, providers benefited from incremental payments when it had come to the use of therapy. That's not going to be the case under PDGM. The therapy services are still payable or allowable under the calculation, but it's going to factor into the clinical collection of data. And Dan, we kind of talked about this because some of the providers, they've called wanting to cancel their contracts with therapy because they found out that this payment factor is going away.
Yes, just make a comment on that relative to thresholds. For years now, CMS has studied this and felt that if there was any possibility of eliminating therapy visits as part of the payment, they finally achieved their goal under PDGM. On the other hand, I don't believe agencies should panic,
Right.
as we have noted with some of the agencies in speaking to them about PDGM. Keep in mind the therapy is still baked into the payment that you'll receive. And once again, we're going to be looking at clinical characteristics of the patient. This whole theme runs throughout the new payment system is clinical characteristics.
Right.
And so I just want to warn you that I think there's been a lot of issues surrounding this that at least the rumor mill's been quite active relative to the potential of cutting back significantly therapy visits. We don't see that all in the end when we study the payment system intently, that you must keep on producing the outcomes and that you would have been achieving prior to this. I just think that the utilization of therapy will be just scrutinized more closer than ever.
Right. And as you stated, the clinical characteristics is what's going to play a factor into how Medicare compensates providers. So paying attention to those two areas that's going to be found on those OASIS assessments, such as the musculoskeletal rehabilitation, as well as the neurostroke rehabilitation. Those are the two areas that clearly give attention to whether or not there's going to be a physical need for assistance of some type of therapy. Now, our HIPS codes are still around. On PPS, we had the 5 positions. My example is 1CHP1, the first position representing timing and therapy. And then you had your clinical domain, your functional domain, your use of therapy need. And then finally, that 5th position represented the reimbursement that you will receive for non-routine supplies. But under PDGM, you will still see the HIPS codes, but those positions are going to represent different areas of focus. That first one being the timing and admission of source, your clinical grouping, your functional level, comorbidity, and that 5th position right now is just a placeholder. So your HIPS codes, they're not going away, but when you look at them, they're going to have a different definition in terms of what they're reporting in that reimbursement. And I'll talk a little bit more about the HIPS codes later. Now it's time to submit our RAPs. Under PPS, we know RAP was every 60 days for an episode, and you expected your reimbursement to be either 60% or 50%, depending on whether that was a starter care or recertification. And then Medicare expected your final claim to be submitted within 120 days or 60 days before they would reverse that payment. Under PDGM, those RAPs are now expected to be submitted every 30 days, what's called a 30-day period. And that's going to be effective from 2020 to 2021. In 2019, agencies that receive their certification, prior to that, they can still expect to receive at least 20% of their reimbursement. But if you're an agency that was certified on or after January 1, 2019, your reimbursement is going to be 0. In 2021, all certified agencies will begin submitting zero pay RAPs. Although no payments will be made, the RAPs will be required as the data is still necessary to update the common working file to report your home care agency as the agency of record. The zero RAP payment should be submitted within 5 days once the zero RAP payments start, or the final rule said that there's going to be a penalty assessed. The RAPs will be processed, but no payment will be made to providers. So the expectation that the providers will submit these no pay RAPs and receive their full reimbursement upon submission.
Just a couple of things I wanted to add. When we talk about new agencies being certified in 2019, that also under the definition of new provider, providers that have had changes of ownership in 2019 are considered quote unquote new providers, and they too would not be paid they would not be paid the 20% for RAPs. They would fall under the 0%. The other thing on this slide that I'd like to make mention on these no pay RAPs, again, you may think, well, that's off until 2021, but keep in mind that's only 13 months from now. We're going to have the issue becomes with a zero pay RAP there will be a penalty if you don't submit within 5 days of start of care. The penalty is an interesting arithmetic type of calculation. If you look at the regulations, it says there would be a 1/30th payment penalty for every day. So if the period is 30 days, you would be penalized 1/30th by being 1 day late. However, if you look into the fine detail, that's not really the case. So let's say if the agency turns in either the notice of admission 2022, and then we get to that point, or the no pay rep, which will happen in 2021, on day 6, so 1 day late, it will lose not 1/30th of that payment, but 6/30ths. It will be considered 6 days late, even though you may argue the point, I had a 5-day period to do it. On day 6, we submitted. It won't work that way. You'll get a penalty of 6/30ths, or put it into arithmetic another way, 20% penalty. So once again, this becomes so crucial. Again, we're thinking, well, we're still a little ways away from happening, but this is going to be upon us once again in quite short order.
Wow. So it's kind of like when I purchase a sofa and they tell me no payments, no interest for 1 year.
Then you're 1 day late after 1 year.
I get a year worth of interest.
That's right.
Got it. Also, the final rule states, as Dan mentioned, for 2022, that these no pay wraps are going to be replaced with a one-time submission of a notice of admission to eliminate the need of submitting these multiple zero wraps. So Medicare rationale is that this is going to reduce the paperwork burden for the providers, but it is also supposed to protect the Medicare Trust Fund and mitigate the potential fraud and abuse from submitting all these wraps. So that's what we have to look forward to for PDGM in terms of submitting wraps. So you'll receive a payment of 20% if you are already certified prior to 2019. You'll start submitting no pay wraps for 2019 if you were certified on or after January 1. And then all providers will be submitting no pay wraps for 2021. And then 2022, that's going to go away, and we'll be filing what's known as a notice of admission, because again, home care providers, you still need to get your agency out there as the agency that's providing care. So this is one of the ways that Medicare is allowing you to do that, and only having to do the notice of admission once. You don't have to file it every 30 days like the wrap. Once you do that notice of admission and your patient stays active, that is your information on file. Now let's talk about the final claims. This has been a slide that Medicare has put out, and it's going to be something that we're going to focus on too when we look in terms of those final claim payments. Episodes that began in 2019 and end in 2020 will still be handled as a transitional episode and paid under the PPS system, not the PDGM. But a started care or recertification period that begins on or after January 1, 2020 will be processed under your PDGM. Now, the final claims are submitted after the 30-day period is completed. The final claim payment is not based on that HIPS code that you reported on your wrap. So that one CHP1 that we talked about, that may have been derived from the OASIS assessment, but when it comes to your final claim claim, that's not going to be the methodology that they're going to pay it under. When that final claim is submitted to Medicare, Medicare is going to check for matching OASIS data through that iKeys help desk that we talked about earlier. If the query finds that the OASIS is on file, Medicare is going to pull from 8 questions from that OASIS assessment to use for your PDGM case mix scoring. M133, which is your hospital risk, your M1800 to 1860, which is going to cover your current functional level for the patient. And that's highlighted in this graph under that green section, and they're going to define that information collected from the OASIS in a low, medium, or high score. The other data that's going to be used will be your period timing and that inpatient discharge status that we talked about, which is collected from the claim. And that's that blue section when we talked about making sure you have your emission source and your timing, whether or not you're getting that claim from the community or the institution, it's going to have an impact on your Medicare reimbursement, as well as whether or not it's classified as early or late. The other area is your diagnosis coding. Both your primary diagnosis code is going to factor in, which is that orange section, as well as a comorbidity adjustment that's going to be reported as an additional means of getting payment from Medicare, and that's defined in that gray area. Now, this data is put through the PDGM grouping program, which produces its own HIPS code, and it will replace the one that was submitted on the RAP to determine the expected PDGM reimbursement amount. During this process, Medicare will also check for adjustments to that blue area, whether or not you reported the correct emission source and timing. Under PDGM, the HIPS code derived from the OASIS was only used to calculate the 20% payment. So the final claim is going to be based on this Medicare PDGM. So they're no longer going to match, and Medicare is going to pay you the difference of what you received in that advance payment for that year, but it's going to be not necessarily 80% that you're expecting, but the difference once Medicare comes up with the PDGM calculation. Just like under PPS, Medicare, when you submit that final claim and Medicare is looking for that OASIS to match, under PPS, Medicare used an 18-digit matching key code. But under PDGM, when Medicare is looking to match the OASIS assessment, they're looking for a date that was reported, and it's going to be on the claim now, and it's going to be under what's an occurrence code. In PPS, we seldom had to use occurrence code, but under PDGM, occurrence code are going to be a part of the routine billing process. So occurrence code 50 will allow Medicare to look into the IKEYS area for the claim and match the OASIS assessment. If that OASIS isn't found, the claim is going to be returned to the provider, or as we billers say, RTP. Also, the diagnosis codes on OASIS will no longer have to match the diagnosis code that's found on the claim, because the diagnosis code found on the OASIS assessment is not what PDGM is going to use to make its calculation. If a diagnosis code change is needed, the new code should be reported on the next 30-day period. And if it's a major change in the condition, the patient has an either improvement or decline, then an other follow-up assessment would be needed. And we're going to talk a little bit more about SCICs in a moment. Now, not all revisions to the OASIS assessment will require that you make a correction to the claim. Remember, in terms of the OASIS assessment, Medicare is only looking for those 8 functional items that are found in that green section of that grid. So if one of these changes are made and the patient feels that this change is going to have an impact, then an adjustment would need to be done. Now, the comorbidity adjustments, Medicare will define it as either no, a low, or a high. When coding, remember that codes like signs and symptoms or just generalized codes, they're not specific enough in terms to define the primary reason a patient is receiving home care. So Medicare wants to know, why is this patient homebound? Why is this patient receiving home care? One of the codes that was given as an example was the use of gait or abnormality or generalized weakness. This would not be a wise choice to use as a primary diagnosis. Not saying that this would not have an impact on the patient's ability to improve, but as a primary diagnosis, Medicare would not accept this and use it for reimbursement. So because of this, ICD-10 codes that begin with the letter R, if you notice, they're not found on the PDGM list of approved codes. So you want to make sure that your coders, that they are aware that when they're coding this care, that there are certain codes that they need to make sure that they stay away from, and they need to make sure that they learn to code with specificity. Generalized codes, again, are not the way to go when it comes to PDGM. PDGM allows for this comorbidity adjustment, which is tied to poor health outcomes and a more complex medical need of care when it comes to managing the patient's cost. So what Medicare has done is they've designated up to 24 secondary diagnosis codes that can be included when you're reporting the patient's care. In order to qualify for the low comorbidity adjustment, there are 13 subgroups that are out there that you can find to see if your patient has one of those diagnosis codes, which would have, as it says, an impact to the patient's ability to improve under their home care episode. Now, for a high comorbidity adjustment, Medicare has 34 interacting subgroups that are out there. So make sure that now you're preparing yourself, you're looking at those different ICD-10 codes. What's the list that Medicare has approved for primary codes? What are the 13 comorbidity low adjustment groups out there, as well as the interactive subgroups? It wouldn't be bad for you guys to do an audit just to see what diagnosis you guys are routinely using in your home care to see if you would fare well under PDGM if you did not change your practice. But now is the time to take a look at that, because Medicare says that these comorbidity adjustments can increase an agency's payment by up to 20%. And I was talking to Dan about this. I was saying how when the proposed rule had come out, they were talking about reducing the providers' reimbursement by 8%, and everyone was up in arms about losing 8%. So I feel that they should be equally as up in arms about losing a possible 20% just for poor coding. So these diagnosis coding, primary coding, these comorbidity adjustments, they're out there for the provider to use to gain the knowledge to make sure that you're able to provide the best specific coding out there. So if you're doing these things, then you will be able to get your referral, determine where it's coming from, whether or not it's a community or late. You'll be able to look at those clinical groupings, make sure you have adequate principal diagnosis coding, that you're not just using generalized coding. Look at those functional impairment levels on the OASIS assessment to make sure that the assessment clinician is assessing to the best of her ability. And also make sure that you are utilizing the comorbidity adjustments, because that could have an upward of 20% impact on your reimbursement. So I hope this information did provide you a little more understanding on what to expect when it comes to your PDGM reimbursements. Now, I also want to talk about some other industry updates that you guys don't want to lose sight of. The review choice demonstration for Palmetto providers, it's still out there. Ask the Illinois providers who's been doing it since June, as well as Ohio for September. Texas, North Carolina, and Florida, they have been rescheduled and placed on hold because Medicare does want the providers to be able to focus on this 2020 change. So this is still coming in 2020. So if you are a Palmetto provider and you're in Texas, North Carolina, and Florida, don't forget that you guys still need to keep your eyes open for your selection date and your date to start submitting the data to Palmetto. The Medicare beneficiary identifiers, or the MBI numbers. We know that Medicare was moving away from using the Social Security number as the health insurance number for Medicare. Medicare says that all the members have received their new MBI numbers, and effective January 1 for 2020, these MBI numbers are the ones that should be submitted on your claims. These claims will not process without this information. So you're already getting ready to take a reduced reimbursement amount for your RAPs. You're going to have a longer time period to collect your 100% payment. You don't want to lose any days of payment because you're not reporting quality data on the claim, such as the correct Medicare number. And finally, the health insurance eligibility system, or the HET system. Some providers are still signing into the Medicare system and doing eligibility checks based on the HIQH and the ELGA feature of the common working file, Medicare says bye-bye February 1. So they're giving you time to make sure that you align yourself with a HETS vendor so that you can make sure that you are getting your eligibility done. So those are areas that I was thinking would be beneficial for the agencies to take a look at. Dan?
All right. Again, welcome. We knew very well that the billing portion of this webinar would be somewhat time consuming, but we wanted to touch on the strongest points. As you can see on our slide here, we're facing somewhat of a hurricane out there as we move into PDGM. You know, without a doubt, the intensity level in your back office increases so significantly. And what for instance, let me just give you, for instance, you've got diagnosis coding changes coming at us. We have therapy utilization changes to have to deal with. We have RAP payment changes. And last but not least, on a summary basis, we have this behavioral adjustment payment reduction. You might recall that in the proposed rule, CMS felt that we being the home care industry, will react to the new payment methodology by changing our behaviors, and they assume that this would be worth 8% reduction. How they come up with these numbers is anyone's guess. The final rule kind of shaved off about half of that. We're now looking at a behavioral adjustment payment reduction of a little over 4%. Heck of a lot better than 8%, but nevertheless, you can see that CMS is predicting that once again, home care providers will change behaviors. So my focus today will be more on the financial side, certainly on the revenue cycle when it comes to the most important change of all that we see on our end with our client agencies is cash flow. Let's just talk about, first of all, the PDGM threats. As Tony alluded to in her presentation, one threat certainly comes in questionable encounters, meaning you say the primary diagnosis has to be specific to be assigned a clinical grouping. These generalized diagnosis codes that were used under the PPS system will generate $0 as far as reimbursement. So again, as I just mentioned before, these diagnosis coding changes are intense, and you must have someone available to your staff, if not in-house, outsourced, who will deal and be very competent relative to their knowledge base when it comes to coding. Episodes, again, another threat is episodes 30 days or less. Short-term length of stays will loom large. So keep in mind, under the PPS system for 19 years that we dealt with, we had 60-day episodes. Whether that patient was discharged with goals met within 30 days, you received a 60-day payment. Keep in mind that according to CMS, and I find this a little odd, some of these numbers that they produce, episodes ended 30 days or less under PPS almost 25% of the time. So if one could extrapolate that percentage over what our new PDGM payment system would look like, you could see why this is such a threat, that if you have episodes ending within 30 or less days, where you might have had a 30-day or 60-day episode payment of $3,500, let's say, in the purest arithmetic sense, you would only receive half of that because it's going to be a 30-day period if that patient is discharged with goals met in the 30 days. And next, we have the 30-day LUPA rule. We will have differing LUPA visit amounts per each 30-day period, rather than the old PPS 60-day numbers that were out there with us. This is going to be extremely critical. In fact, we go into a little bit of depth on this next slide. And we really think this is a significant threat. Under the old PPS system, CMS indicates that lupus accounted for about 8%, 8 to 9% of episodes under that system. Well, we really have to, as I like to call it, meticulously manage these visits within each 30-day period, possibly to avoid that LUPA, meaning to say we must communicate. Communication will be intense. We've got to communicate LUPA thresholds to the entire interdisciplinary team. You've got to communicate with patients to avoid potential scheduling conflicts, as often happens. Staff must always attempt to reschedule missed visits. One missed visit may cause you to fall under the LUPA payment. And be cautious when tapering visits during the second day 30-day period of care. Again, without information at hand, you could inadvertently end up with a LUPA payment on your second 30-day period. And of course, there's the full payment, 60-day payment. Once again, length of stay is critical. And I think Tony brought this up regarding functional levels and comorbidity adjustments may change.
Yeah, exactly. As I was stating, if you admit that patient and you find that there has been a change in these areas as defined on that grid, these are areas that will have a direct impact on your reimbursement. So you need to assess whether or not you need to do a significant change of care and get that information reported to Medicare so that you will receive your adequate reimbursement amount.
Let's move on to revenue cycle risks. Do you really know what your average time to drop a RAP is, and the average time to process a final claim within your agency? My next slide will get into a graphic demonstration of what's going to happen to cash flow, and so critical will be the time to either drop a RAP or to process a final claim. You have to look at your current bottlenecks. What causes in your agency to process RAP and final slower than what you would like? Is it clinicians' completion of documentation? Someone monitoring the documentation, managing and looking at the whole admission process. Without a doubt, intake is so now critical. If it hasn't been already, it just intensifies under PDGM. Tracking, something as simple as tracking physician signatures before that final claim can be processed. All of these things all play into the risks we are now entering as we head into PDGM in just 6 weeks from now. So let's take a look at cash flow. We've got a scenario here, and we're going to look at what we're all used to seeing, a PPS 60-day episode. Let's presume that episode pays $3,500. So we're going to talk about a perfect world here. And in a perfect world, if you had a start of care on 1/1/20 under the old PPS system, you know, hopefully people could submit RAPs or will be able to submit RAPs in 7 days. Again, I'm just talking perfect world. The average RAP submission is 12 days nationwide. My little chart here will look at it as 7 days as being a perfect world. The RAP payment should be paid in 7 days by the MAC. Episode ends 60 days later on February 28th. Final claim submitted 14 days after the episode ending. What's your average? Likely not 14 days. And then, of course, perfectly happens, the final claim gets paid 14 days after submission of the final claim. So we move on to our new PDGM date and timeline. We start with, again, RAP submission 7 days after start of care, RAP payment 7 days after submission of RAP, final claim submitted of the 30-day period. And once again, final claim submitted on February 13th, which is 45 days after start of care. Final claim paid 14 days after submission of the final claim. And again, look at the dollar amounts. We're still going to come out to be $3,500, but it's going to be spread out over a much longer period of time. So we're now into the second period. RAP submitted February 7th. RAP payment, again, perfectly 7 or 8 days after the RAP submission. Episode ends on February 28th. Final claim submitted exactly 14 days after second period, which is the episode ending. And then the final claim paid 14 or so days afterwards. Again, $3,500. Here, though, this particular slide puts it in graphic form. This is where I think we all, especially the smaller home care agencies, have to be so concerned about. You know, having talked with a number of larger providers, they have so much more resources. If it isn't personnel resources, they have financial resources that the smaller home care agencies in this industry do not possess and will not possess. But again, let's take a look at how cash flow will be impacted. As you can see, the first horizontal line is our PPS system, where total 60-day episode payment would be $3,500. The RAP payment occurring $2,100, 60% of the $3,500 came to you into your bank account on January 15th. Keep in mind, final payment, March 31. Look at what happens under PDGM. Again, we have 2 periods here. We have period 1, where you're going to get 20% of $1,750, half of $3,500, just for our example. That comes to you on January 15th. And then we have, again, now we've extended the patient into the second period. We drop the RAP. That second period RAP payment gets paid $350 on February 15th. And we don't receive any significant amount of cash until we drop the final claim and get paid for it on February 28th. So if you look at the graph, you start of care January 1, all the way to February 28th. So we're looking at 60 days here. You will be paid $700 versus $2,100 under PPS. Your cash flow has been drastically cut by, it comes by 66 2/3%, $700 versus $2,100. How do you handle the fact in your agency where payroll and payroll related costs equal 80% of your agency's costs? Payroll can't be missed. Payroll's usually every week, or most people bi-weekly. You've got to not only pay the payroll, you got to pay your payroll taxes. But this is where the real rub is going to come under this cash flow scenario here. And again, you'll get a final payment on the 20th of February. So even then, so look at that, that's $2,100, which will have to take you all the way to March 31st. And that's where you'd receive your final claim payment of $1,400. This transition period from PPS to PDGM will be crucial for you to understand and for you to fill in the cash gap that will incur. Keep in mind, you know, this isn't all going to happen on January 1st. The critical time period likely will be the latter part of January, certainly February, certainly March, and into April. But keep in mind, this scenario that I painted here on this slide is a perfect world where you're dropping RAPs in 7 days, you're dropping final claims in 14 days. That doesn't happen. It could be software glitches early on. It could be your Mac having a software glitch in processing claims. And that just expands the time period, and just certainly the cash dollars amount will just certainly get more spread out this way. So again, this is something that will be crucial in the next 2 months. I mean, we're talking about mid-November today. This is probably going to impact most of the agencies starting mid-January as we get through the transition period of PPS payments, and probably go somewhere in the area of 90 to 120 days before we see some settling of cash flow. Again, we still got a new payment system here. We don't know sometimes how will be affected by the payment itself, the dollar payment of the total episode. So just from a cash flow standpoint, it is so crucial to have some backup plan to suffice the shortage that we're all going to see. So HHAs, what are they going to need to do? Well, you've got to have some access to cash, whether it's your internal capital, meaning to say, do you have the ability from prior periods to have a certain amount of capital that you can access? Do you have cash reserves? And what I mean by cash reserves, do you have an accumulation of cash that's either sitting in your agency's checking account, your agency's savings account, somewhere where you could tap into? You know, the first item, capital, and that's, you know, you could say that until the cows come home. Small agencies don't have the ability to find capital. We're not some large providers that are out in the public market or have the ability to raise joint venture type money, as you see. So does this relieve us to the credit side of things? Where can we go to borrow money? Stronger agencies, small agencies, can establish lines of credit with a bank. If you haven't established or attempted to establish a line of credit, we've done a lot of work with our agency clients in getting them to the point where we've gone to the bank. Again, you've got to go through all this line of credit underwriting, and it's not a short process. It's somewhat of an elongated process to get a credit approval for a line of credit. What we've also seen, much to our dismay, is the fact that there are companies, and you get the mail, you get this marketing mail quite often about, we will loan you money, lend you money. Little do they tell you about what the interest rates are. Most of these companies will charge on the low end 10% and on the high end 35%. Some who are based in the state of New York, where they do not have caps on interest rates, will charge well over, ready for this, 100% interest and on up. We had a client that we picked up where they were being lent money at an annual interest rate of 135%. But again, you know, if it comes to credit, is it something that, in order to get you over the hump of this 3 or 4 month period of time, what do you use? A credit card, get cash advances on your credit card? Do you go to your rich uncle? I mean, who is it? You've got to have the ability to have some sort of access to a cash reserve. As we've always said in the CPA business, and I hate to say it, but I'll bring it up. The first week you miss payroll, or the first day you miss a payroll, will be the last day you're in business. And that's sort of a difficult thing to deal with, but you cannot miss payroll. And if you think that the government's going to fund you by you not paying your payroll taxes on a timely basis, again, that's going down the path of failure. But in any event, this is what we're facing. And it's not going to be pretty in the first few months of the new payment system. So again, you know, what things affect cash? The days it takes to drop a rep, the days to drop a final claim, the case mix where you'll have now 432 432 possible case mix adjustment payment groups to deal with. Periods per patient, 1 period, 2 periods, how many more? Institutional versus community. We talked about the referral coming out of a post-acute care facility and considered institutional. It's predicted that those referrals in the first 30-day period only, we're only talking about the 30-day period, will be $600 to $800 more for that 30-day period payment. That's what's been predicted. We'll see. Without a doubt, you know, having talked about and you having a knowledge base of the new payment system, billing capacity in every agency will be strained. I mean, you're going to want to bill wraps and final claims on a daily basis. You want to manage your wrap or your auto cancels. You want to manage unbilled claims. Research balances where paid amounts do not match expected payments. Why is that? It's going to be so much more intense now. Establish follow-up protocols. Do you have protocols in place, or is it something that I'll get to that when I have time type of approach? And of course, we can't forget the continued emphasis on commercial and Medicare Advantage billing. That's not going away. As of now, they are not, as our knowledge is of this, they are not converting to a PDGM payment system as of now. So you're going to have to deal with that as well going forward. So as somewhat of a summary though, we've got, when we talk about billing capacity being strained, we've got, of course, an educational process that we all have to go through. A very insufficient transitional time. I mean, think about the fact that we all would have all loved to have seen the RAP reduction far less than from 60% or 50% to 20%. You know, we've talked about in the industry, why couldn't they have stretched that period of time out more? Billing staff required training with your software, a thorough knowledge of what the software will help and making sure that they do produce acceptable claims. And just the sheer workload increase. Look at that, doubling of reps, doubling of final claims, doubling of open claims, doubling of cash postings, doubling of overall billing volume. So as a result of all of this, it's an absolute priority on maintaining an accurate accounts receivable balance. So you can manage those receivables, which means you can manage better your cash flow. So in conclusion, as we at TAD would like to say, isn't it now the time to outsource your billing functions and activities with TAD? If not now, when?
Good question, Dan. Thank you. We have a couple of questions here. If you guys, I know we're right at our hour time limit, but if you want to stick around for a few minutes. There was a question regarding the slides or the presentation. They are available when you log out. Please include that in your questionnaire that you would request, like those slides with a good email address, and I can email those to you. We're also in the works of getting these recorded, pre-recorded webinars available on YouTube so that you can review them again at your leisure, and then we'll be updating them as information becomes available and time allows. There's just a couple other questions. Tony, during your presentation, I believe it was, somebody asked, how can you compare current claims under the PDGM methodology?
I believe you said you had the answers to those questions.
Yep, I had that in my webinar, Billing at a Glance. A lot of the vendor softwares are providing copies or grouper tools, PDGM tools, where they can take your current data and do an analysis on it and tell you what they would be, where you're deficient, and what your current coding practices would result in. Also, CMS.gov, on their website, cms.gov, you go log in and type in PDGM. It'll take you to their resource page. If you don't have a software that allows for the grouper tool, there is a grouper tool available at the CMS website that allow you to, it's an interactive worksheet. You download the tool and you can enter in the information. It's in an interactive Excel document. There's several tabs in that tool. It's a great tool. It shows you the different diagnoses that qualify for comorbidity. It shows you the different LUPA thresholds for the different PDGM groupers. One of the other questions was, you indicated that there can be up to 24 different diagnosis codes, that secondary diagnosis codes, but a UB04 only allows for 8 or 9 place settings. How is this possible? The answer to that question is that the electronic, your claims are not submitted by paper claims. the printed, it will only print the first 8, but if your vendor has created their software appropriately, you can code in as many as the 24 and they will be transmitted on the electronic file. So Medicare will receive those additional diagnosis codes. Then there was another one on the therapy thresholds, or the LUPA thresholds, I'm sorry. Currently, it's 4 visits or less that qualifies for a therapy for LUPA. But on the PDGM grouper tool that I told you about, the LUPA thresholds can be as few as 2 visits per 30-day period or as many as 6 visits for the 30-day period, depending on the group that you qualify for. So within that grouper tool, there was another tab that also indicated what the LUPA thresholds were for those grouper values. Tony, did you say you had another?
Yes, there was also information, regarding the 45s in the OASIS. Because PDGM is moving to a 30-day period, they wanted to know whether or not those certification in the OASIS would change, and that's not the case. The certification period will remain 60 days for the 45, and that certification period will have 2 period episodes for billing, as well as your OASIS data collection. That still will remain a 60-day period. You're still required to make sure you get that information submitted within the 5 days, and that OASIS data collection is still in that 5-day period. So those 2 still remain 60-day certification information. It's only the billing that's going to be changed to 60-day periods.
All right, thank you. I think that kind of sums up everything today. Again, our contact information is right here on the screen. So if you have additional questions or comments, or we're interested in TAD services, please shoot us an email. You can also visit our website, www.tad-usa.com, and you can also request or send emails through our website as well. So there's lots of changes in the industry. You're not the only one of our valued, if you're not one of our valued clients, we would love to assist you and your agency with your billing and accounting needs. The professionals at TAD have been providing accounting and billing services to home care agencies for over 15 years and doing the tax work for the industry for over 30. So often agencies are owned and managed by clinical professionals who can't keep up with the constantly changing Medicare regulations. At TAD, all we do is home health accounting, billing, and tax work, so the agencies are free to focus on the clinical and daily operations of their business. In this new changes with PDGM, that's even more critical. So at TAD, we say manage your capabilities and outsource your challenges. We want to make sure that you're getting paid everything you're entitled to collect, and we hope that you would consider using TAD for your billing and accounting needs in the future. Thank you, and thank you for attending today.